Ever wondered how economic conditions of a country can predict the future value of its currency? Welcome to the world of Forex fundamental analysis. This is the method that seeks to forecast the future value of a currency by analyzing a country's economic indicators. It's a bit like being a detective, sifting through economic data to get a clear picture of a currency's health. You see, every currency is tied to the economy of its country. When an economy is booming, its currency tends to strengthen. When an economy is in recession, its currency tends to weaken. That's why we look at factors like economic conditions and monetary policy. Forex fundamental analysis is like the heartbeat of currency trading. It's the rhythm that guides traders, informing their decisions and shaping their strategies. So if you're serious about trading, get familiar with this analysis, because understanding these economic factors is crucial to becoming a successful Forex trader. Now that we've introduced the concept of Forex fundamental analysis, let's delve into its key indicators. First up is the Producer Price Index, or PPI. This is like a family reunion of indexes, each member representing the average change in selling prices received by domestic producers of goods and services over time. The PPI essentially gives us a seller's perspective on price changes. For instance, if the PPI is rising, it could indicate increasing inflation, potentially lowering the value of the country's currency. Next, we have the Consumer Price Index, or CPI. This measures price changes in consumer goods and services like gasoline, food, and automobiles. Think of it as a snapshot of the cost of living. Sometimes it's also called headline inflation. If the CPI is high, it could mean the cost of living is increasing, which might lead to a central bank increasing interest rates to control inflation. This, in turn, could boost the value of the currency due to higher returns on investment. Lastly, we have the Gross Domestic Product, or GDP. This is the monetary value of all finished goods and services produced within a country's borders in a specific time period. It's like a scorecard for a country's economic health. A growing GDP signals a healthy economy, which can attract foreign investors, increasing demand and value for the country's currency. Now let's imagine these indicators as cogs in a machine. Each cog affects the others, and together they drive the machine that is a country's economy. A change in one cog, say the PPI, can influence the CPI and GDP, which in turn affects the supply and demand, and ultimately the value of a country's currency. These indicators, when analyzed correctly, can provide a clear picture of a country's economic health and hence its currency's future value. Remember, understanding these indicators is like having a crystal ball that lets you peek into the future of a currency's value. So take the time to study them, and you'll be well on your way to mastering Forex fundamental analysis. While understanding indicators is vital, keeping an eye on financial news is equally important in Forex fundamental analysis. It's like being a detective, piecing together different economic clues to form a complete picture of a currency's value. Each news piece, whether it's about interest rates, inflation, unemployment, or political decisions, can significantly impact the supply and demand of a currency. To stay ahead of the curve, you need to have your finger on the pulse of financial news. Websites like Bloomberg, Businessweek, CNN Money, The Economist, Financial Times Currency Markets section, and FX Street are treasure troves of financial updates. These sources offer an influx of information that can help you anticipate market movements and make informed trading decisions. Remember, the foreign exchange market is incredibly dynamic, and news can shift the landscape in an instant. Staying updated with financial news helps you make informed trading decisions. Forex fundamental analysis is a key ingredient in a successful Forex trading strategy. It's a method that involves studying the economic, social, and political factors that influence the supply and demand of currencies. This includes indicators such as interest rates, inflation, and unemployment, as well as the Producer Price Index, Consumer Price Index, and Gross Domestic Product. Remember, the currency value of a nation isn't just a number, it's a reflection of its economic health. By understanding these factors, you can make informed decisions that could lead to successful trades. To deepen your knowledge, you can visit websites like Investopedia, Bloomberg, Businessweek, CNN, Money, The Economist, Financial Times, and FXS Street. Additionally, don't forget to explore other aspects of Forex trading such as technical analysis and money management. They're equally important in crafting a robust trading strategy. Remember, Forex trading isn't just about numbers, it's about understanding the economic factors driving those numbers. Stay informed, stay successful.